At the end of 2022, I did a video on Tesla stock saying that if they performed, if they executed, Tesla could have over 200% upside potential over time. Since then, year to date, Tesla stock is up over 50%. At one point, it was closer to 70 to 80%, causing investors to wonder, has it gone too far, too fast? Well, I wanted to update you with my latest thoughts based on their investor day, as well as their fourth quarter earnings results to share, hey, this is where I think Tesla could potentially go in the years ahead based on an updated valuation. I'll share my thoughts on the valuation towards the end of this video, as well as sort of the key inputs leading up to it throughout this video. If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. If you enjoy educational investment videos, please make a point of hitting that subscribe button. So let's understand what's going on here. So they had their investor day. The stock dropped nearly 6%. Why is that? Well, actually, this is part of my value proposition to you, the viewers, is just because my prior experience included working at a multi-billion-dollar hedge fund. So I could sort of try to channel what is Wall Street thinking, the highs and lows, because arguably it was a favorable investor day. And so I think there are two key things, two key reasons that Wall Street was disappointed. Wall Street, a bunch of meat eaters for the most part, many of which, and they want a ribeye. They want something juicy that they can bite into. And so the two reasons is, one, the master plan was sort of vague in terms of the specific details for Tesla, and two, people like having a specific target to dive into. And let me share what I'm thinking. So the master plan 3, previously they did a master plan on master plan 1 and 2, which they've already delivered. Master plan 1, take the Roadster, take an ultra luxury vehicle, take the profits from that, reinvest it into research, so that way you can get mainstream, hyperscale your business, which they've delivered. Master plan 2 talking about solar energy and energy storage. Master plan 3 is more macro focused, talking about how can you eliminate fossil fuels in the world. This is talking about trillions of dollars for governments, businesses to invest. This is well beyond just Tesla. And so that is a little disappointing for investors, sort of saying, hey, it's cool for you to talk about this, but what's Tesla going to do in terms of, give me some tangible numbers to think about 3-5 years down from now, in terms of where Tesla is going to be. Now, yes, Tesla is clearly solving over half of the solution with renewable power, energy storage, as well as a switch to electric vehicles. But they did call some other interesting things that I think weren't on, investor or analyst business cards, like, bingo cards, I should say, because, like the management called out how the switch to heat pumps is actually low-hanging fruit, and the potential from switching to heat pumps could actually be even greater in terms of the reduction of fossil fuel usage versus electric vehicles. That's really interesting. So Musk actually said, hey, we might even get into this at some point. Also talking about sustainable fuel planes and boats, thinking actually the market here is actually fairly small, only 5% relative to the big impact with EVs. The second point in terms of having some tangible thing that Wall Street can bite into is this 20 million annual vehicle production. This is something that management actually called out, I think either last year or the year before, sort of saying, hey, in sometime in the 2030s, we're hoping to get to 20 million annual vehicle production. And based on where they're currently at, if that's 10 years from now, hitting that target, that's a 30% CAGR. And so that does make you wonder, well, wait a second, does that sort of cap your growth rate from here? Because a lot of investors have thought, to the moon, 50% annual growth. If you're targeting, let's say 30% growth, and you might have to be lowering your prices in the future, is it going to mean that 30% is the ceiling? Now, maybe you get, self-driving as additive stuff, and you get, cool new products, maybe even get into heat pumps or something like that. But it is this sort of question of, well, does that mean the ceiling of your growth rate is closer to 30% over time? And this also sort of goes against what management was previously calling out, because management, talked about a 50% growth rate, and this was as of their fourth quarter earnings update. And they talked, hey, we remain ahead of the long-term 50% CAGR that they've talked about with 1.8 million cars. This is also confusing for a lot of investors, this 1.8 million cars, because they delivered 1.3 million in 2022. So really only like 37% growth from a delivery perspective, about 30% from a production perspective. Is that really the hyper growth rate that folks were expecting? Now, clearly they're still delivering lots of free cash flow and profits, which is what investors want to see. But this 50% growth rate, maybe that's not, maybe the ceiling that we're thinking about with Tesla needs to be much lower. So management with this 50% growth rate, they've sort of tweaked it a few times, in my opinion, sort of saying, oh yeah, it's not 50% going forward. It's 50% off of the base that we had in 2020. And so if you assume the base of 2020, well, we're actually targeting, 1.8 million, which is well ahead of where we would be at a 50% CAGR since 2020. Personally, I think this is just an example of sort of reaching a little too far. And I suspect that in the next 2 to 3 years, you see Elon Musk completely forget about that 50% target, and I would be very surprised if they're able to keep that up. Maybe they can, which would be huzzah, like tremendous upside. But just based on the fact that they're not currently doing it like a 50% true CAGR, it's more like, hey, 50% from 2020. That's what makes me think they're just going to forget about it, or they're going to walk it back at some point. We'll see. We will see. Now, part of the thought process here, and this is what also has caused Tesla stock to weaken recently, is that they announced price cutting for Model X and S just earlier today. And this follows earlier price cuts in January for two of their best-selling models, the Y and the 3. And these aren't small price cuts, like 20% cut for the Model Y, 14% cut for Model 3. Now, Elon Musk said on the last conference call saying, hey, actually demand's so good, demand is literally 2 times production, that some of that price reduction, we actually, we reverse course for some of it. But it's still weird for this action to occur if demand is truly so good. Now, he suggests that some of it's to squeeze competitors, some of it's due to, waning demand, so maybe demand might be weaker, but Elon Musk says that's not the case. And then another aspect is like, hey, maybe this is to qualify for federal tax credits for some consumers to purchase. So I will see, but this clearly does make it harder to achieve higher profit margins going forward. So what are my thoughts? What are my forecasts for Tesla stock going forward? Well, first, if you're looking to take charge of your investment journey, consider unrivaledinvesting.com for compelling investment ideas, real-time portfolio updates, and our exclusive Discord server available for annual subscribers. And full disclosure, this is not financial advice. So, as I mentioned in my last video on Tesla, really there's 2 paths ahead. One of which is, hey, the economy keeps growing, there's a soft landing. Another which is recession. And recessions will make it tougher to sell a, like a $50,000 vehicle. If that's, let's say, the average price across several different, models. So that, I look at that and I think, talking about even 50% growth, that would be close to impossible to achieve if we go down that road of a recession. And as long as interest rates keep moving higher, the odds of having that sort of soft landing get much harder to land, much harder to achieve. That said, so far, everyone's sort of looking at a strong consumer, so the growth path looks exciting, and that's part of the reason why I think Tesla stock has ripped so much higher off its lows. It's up something like 100%. Thinking about the valuation in this environment, now at 194 versus 120 something when I, did my last video on it. So I look at it thinking for the year ahead, given that 30% growth on a, effectively on a production basis, and given the fact that they're also reducing prices meaningfully, I'm lowering my framework for how I'm thinking about their growth, this year ahead in terms of their revenue. And so I'm saying 20 to 25% growth. Maybe I'm being too conservative here. We'll see. Then the next aspect is their margins. Previously, I assumed a bit higher. Let's see how this plays out. Most recent quarter, you didn't have sequential margin improvement. Then you also see management talk about how they're going to be making some margin investments because of these price cuts. And so I think, when you're thinking about margins and where this business could be, you do have on the one side really high margin software updates, full self-driving. That will be a nice, positive for them over time. The other side is that, lowering the prices of your vehicles will hurt your margins over time. And so thinking about, and during the fourth quarter, sequentially, their margins, so from the third quarter to the fourth quarter, their margins went down. Their operating margins went from like 17 to 16% roughly. And so, thinking about that, how should we consider their margins long term? I'm saying around 20%, but we will see. We'll see how they deliver. Either way, it pencils out to, Wall Street's kind of expecting around a 50 times forward earnings for a company maybe only growing 25, maybe closer to 30%. We'll see. I try to, with my, frameworks, and keep in mind, this is a hypothetical framework. Stock price can go way higher, way lower than whatever I pencil out. It depends on the execution. It depends on the sentiment. But I personally, over the years, it's important to me to pencil out things that I'm comfortable saying, hey, I think there's a high degree of certainty the management will deliver on this, that they will deliver on this growth. So I'd rather be conservative with, my outlook. And maybe this is too aggressive. Maybe 20% growth is too aggressive. We will see. Then the question is, in the following years, what do they do? And, some mega Tesla bulls will definitely think I'm being way too conservative here, saying only 15% annualized beyond 2023. So for the following 4 years. And then, on the high case, I'm saying 25. I'm sort of spreading out the range of possibilities, partly because of, the conversation about the 50% CAGR growth. Previously, it was 50% going forward. And then it was like, oh, it's 50% off of 2020. Sorry for the confusion. And so I think that change, the price cuts, looking at, penciling out 30% growth in production this year, looking at the risk of recession, thinking about these things, that makes me think over the next 5 years, penciling out around 20% growth annualized. Maybe that's just right for them. Maybe that's too high. Maybe it's too low. But this is something based on the data right now, how I'm thinking about it. Keep in mind, stock price can go way higher, way lower based on this type of execution. Once again, a wider range of possible end multiples. So based on this, 5 years from now, I'm effectively saying, hey, there's the possibility that even if they really do deliver and they go from 80 billion in revenue to 170 billion in revenue, and they have better profit margins, but they only have a 15 times earnings multiple, then you'd have around 50% downside versus maybe 55, 50, 60% upside. Based on, the 25% growth, 25 times earnings multiple. So it's a question of, is that really super compelling? I'm looking at this right now and thinking, when I did my last video saying, hey, if they executed, there's over 200% upside, I thought it was a lot more interesting. But going up, like nearly 100% from its lows, it does make me think that Tesla has gone too far, too fast, too much, too soon, in terms of Wall Street giving them credit for execution that still needs to happen. And I think in this investment environment, you want to find some of the things where you can be a little safer with your assumptions. Like, it's possible that these assumptions whiff and that they deliver much lower. That would obviously be very disappointing for the stock price, in which case, arguably this wouldn't be conservative enough. Now, that would depend on a really tough macro environment, which could happen. So that's why, my own personal investment journey, which I call out to my subscribers at Unrivaled Investing, I'm looking for things that have more of a valuation backstop to them. I might consider something like a liquidation play that has a history of compounding at, well above market rates, history of compounding at 10% plus it trades at a, 30% discount to liquidation value. And that's one of the most recent things that I've been buying that I call out to my subscribers. Or, buying a financial services company that trades at like 15 times earnings and, multi-decade history of way outperforming the S&P 500. So like every investor needs to figure out their own investment journey and think about the risks of whether or not Tesla will ultimately deliver on this. I personally look at the price run up, and a lot of stocks, a lot of speculative stocks have had equally, if not more, greater run ups in the last few weeks. So it does give me, reason to pause and say, like, okay, I think this is too much too soon. And it wouldn't surprise me to see Tesla, and this is sort of my forecast for 2023, it wouldn't surprise me to see Tesla stock back at the lows that you saw at the end of last year, based on if they don't deliver on continued operating margin improvement, if they don't deliver, let's say, on 30% plus growth in the next quarter or two. And if you're looking at that situation, I think investors go, okay, we need to cool off here. And then you see the stock potentially back to $100. We'll see. Of course, once again, this is not financial advice. I'm just sort of sharing, the mindset I think that Wall Street would have if you don't see that 30% growth, if you don't see continued improvement with margins, which didn't happen in the last quarter. So that's, on a sequential basis. So that's my thoughts. If you enjoyed this video, please make a point of hitting that thumbs up, hit that subscribe button, and thank you so much for watching Unrivaled Investing.